Welcome to Gamma On. This is episode 3 of our weekly limited series exploring advanced options concepts with a focus on the second derivative. I'm Oliver Renick, your host. I'm joined again by Shane Skinner, manager on the institutional trading team at Charles Schwab. We are going to get our boots on the ground, Shane.
Yes. We're going to go through the nitty gritty and access to data, right? And so that's going to, it doesn't really matter where you get it from as long as you have access to options data, preferably live, but really any software or any access to live or even slightly delayed data, right? You've got options chain data,
right?
You've got the data. So we're going to
stems from the most basic, because we're going to jump right to calculating gamma, second derivative. But as long as you've got the volatility in the options chain, you're going to get, most platforms are going to fill out the first derivative for you. But the first time I think you hear about this, it's almost kind of like a little fairy dust stuff. You hear Vanna, Charm, Gamma, and it's like, all right, what is this? So here's where we kind of pull back the curtain. I'm going to basically give you the floor to just go, because you do this all the time, and you're going to go through Excel, you're going to go through the platform, and then we're going to try and learn ways to visualize the data, because that's going to be what a lot of people see when we're doing our options hit on the show and we're pulling up charts, you and KG. This is our end goal for this episode, is to kind of know what we're looking at when we look at these visuals. So, all right, where do you begin?
So once you have essentially copied the link to the data, or you've got the data set ready to go and upload, I just go into a spreadsheets application.
You're pulling API basically,
that,
right?
Yeah, exactly. And on different software, they usually make it fairly easy to do this. So the main focus, you're going to want a handful of variables here. Right now, I just included gamma, open interest, and volume, but you can add things like volatility. You can add other Greeks and stuff. The point of this is that for all these second and third level derivatives, you're going to probably have to do the calculations yourself. Most trading software out there doesn't do things like Vanna and Charm. There are some options, but typically you have to pay for them. So if you're trying to save money, the best route is to try to come up with how to do this on your own. And again, you're going to need access to that data. So from here, we're going to go and just simply set up a few columns.
We're doing the S&P, by the way. And for those that are following along via audio, I'm sure this is exactly what they imagined the podcast would be, guys on Excel. But, I think you can also follow along pretty easily just in terms of kind of knowing the data sets that we're using. So it's S&P 500, index, and you're starting with what?
So first we're doing the strike, right? We're creating a column for the strikes that we want to analyze.
Okay.
Next, we're going to create our call.
How many do you choose?
For me, for this example, I did only like 25 strikes roughly.
Okay.
Depending on the expiration, depending on how big it is,
right,
and how much is trading throughout.
I imagine how volatile markets been too, right? Because markets been volatile, you're going to want a wider range of strikes.
Exactly. And there are times where you might notice, you might go 15, 20, 25 strikes before another big one pops up, but those are sometimes on melt-ups and meltdowns relevant. So
we're recording this November 12th. S&P's basically been pinned at 6,000.
Yep, 59.81 right now. It's currently about 2 hours and 23 minutes before the market closed. So next up, let's do the call gamma exposure. So you're going to first take... it's just a very simple calculation. Gamma, for the call of the strike you're calculating, times open interest, times spot price. And we're going to make sure we lock that cell when we click on that, because...
To be clear, we're calculating gamma exposure once you've got the input of the actual derivative calculated from the platform.
Correct. And the reason for locking this is... essentially, we want that to stay locked for all cells, right?
Yep.
Just logically makes sense. Then we're going to multiply it by the contract size. And then we're going to come back. We're going to do it one more time. And the logic behind this is we're going to then multiply by 0.01. And that's going to give us the notional gamma exposure per 1% move in the underlying based on that strike for the call side. Now, again, that can be done in a multitude of ways. You don't have to do it just based on 1% move. You could do it on a 1-point move basis. You could scrape it all together. And the real point more than anything is to just get it all lined up equally, symmetrical, and then we're trying to see visually where are these levels that have way more action or stand out than others, or where's their crowding, where is it hollow.
So it's important that you did kind of have an independent variable that you chose out of discretion, which was the 1 percentage point input.
Yes, that's personal preference. People can do this in a multitude of ways. Obviously, doing it on a 1% level, I'm going to get values that are way bigger.
Yeah, that'll
than
just
doing
change
it on the 1 point.
I mean, again, this is just notional. It's going to change the amount because you're going to take a bigger lever to it, essentially.
Exactly.
If you were to put in some bigger percentage.
Exactly. And then next up, we're going to do the put side. It's the same exact calculation, except you need to make sure you're multiplying at some point by like -100 or negative 0.01, right? And then, we can just double click here, drop that down.
Okay.
Sometimes you'll notice too, some don't register because there's just no open interest or gamma.
Okay. In this case, no open interest.
No open interest. It looks like there, or sorry, no gamma.
Oh,
it looks like, yep.
Okay.
So, next up, we're going to do the net strike. I do this because I think it's important to see what the net value is for each strike, positive or negative.
By the way, that's important that the gamma value literally is, it's asymptotically going to zero the way further out you get, but for practical purposes, it is zero basically.
Correct. And eventually it sort of picks up, and you'll see depending on where you sway, depending on what strikes you're looking at versus where it's trading at, it might go to zero, right? Gamma, like we said previously, is typically highest at the money. Now, what we did here for net strike is just sum the call and, sorry, that should be...
Yep, put GEX.
Yep, sorry.
Which you were just using to abbreviate gamma exposure GEX.
Correct, yep. And then you sum that, and you get it on a per strike basis. Now, the reason why we do that is because we want to see overall as a strike, is it positive or negative net? We find that to sort of be relevant in finding potential foot points or areas to watch of large concentration. Then we just do net total, which is just the sum of all call inputs for all strikes we're analyzing. We're get into essentially interpreting that with KG here soon. But it's relevant to have this because knowing what net total exposure being positive or negative is gives us an idea in terms of what we might expect to happen with vol and in turn price movement and direction.
Yep.
So,
all right.
that is essentially how you run the calculations.
Yep.
Then very simply to display them, you would just highlight, strike, calls, puts. We're going to go to... I'm just going to use the recommended charts tool. How you chart it, you usually do a vertical or horizontal bar chart, right? Pretty easy. I'm not going to get super fancy into decorating this, but what you'll see, right, is there's the blue
Two
is
different
call
worlds
side.
of thought, vertical or horizontal. That's what it all comes down to.
Right, exactly.
That's
and
what
either
matters
way,
the
we're
most.
getting to the same point, right? So 5980 is where the SPX is currently trading at. 5980 large spot for put gamma, not a lot of call. Notice, not a ton of notional call gamma up till 6,000. A lot of put gamma concentrated here between 59, 70, 75, and 80. So this is a rather interesting pocket here. We might keep an eye on it. That 75 might serve as a nice little landing spot between those two near the close here. If not, we are going to either likely see a flush back up to 6,000 or 5950 is going to act as a magnet if these levels break through. So again, we've got about 2 hours and 18 minutes. I know this is going to be posted down the road, but
and so the total, you generally think about the pin as being the total on both sides combined.
So the pinning
put
effect,
and call?
Yeah. So the pinning effect, and we're gonna come in here and we're gonna plot the net strike level, and you'll see why here in just a second.
Yep.
And then we will be on to, I believe, bringing KG on. So we're gonna go plot again strike and net strike. So what this is gonna give us is a breakdown of where is net gamma flipping from negative to positive
Okay.
overall.
Okay.
And notice 6,000 and above,
Right.
positive.
Right.
Everything below 6,000 though, negative. And then
Yeah.
you notice where's the largest level of total net negative. It lines up with where these puts are, right?
Yeah.
And so, again, one would think this is either going to pull back up around here or it's going to sort of get comfy in here. If this breaks, you might get some nasty downside movement continue.
So it's kind of a question of whether or not the market's strong enough to pull some of that dealer positioning downward away from the kind of flip point, the pin at which the dealers would prefer all of this to expire.
Right. What activity is going on? And this is where KG nails it with analyzing volume. We're simply just using open interest here. But again, you can add other variables in there. You can do this for volume similar and just substitute that instead of open interest.
Yep.
There are tons of different things that you can start to break down and sort of play with in terms of these calculations.
Sure. Well, it's just visualization for the most part. I mean, you still got to have the you still got to get the OG gamma data from whatever source. But I think the important thing is that it's useful to see where the puts and the call gamma exposure lines up. But ultimately, converting it into the total net by strike is the most helpful in seeing, I think, the points that we spend the most time talking about, which is when it flips from net negative to net positive. That's really kind of the key thing that we take away from here, I think.
Absolutely. And what levels we might see, again, magnets, support, resistance.
Sure.
If they give, you might start looking to other ones below that stand out. And you notice, you have some areas where you get more action and a couple strikes down than you do closer. So things like that, you see it's hollow, like we've described it before. Those are areas where traders might find opportunities to sort of catch those big moves. But again, like you said, just as quickly as you can rip through that 10 to 20 point range, you can go right back. So,
well, that's where the kind of the guardrails analogy,
really
you have to keep in mind that these guardrails, they bend and they can break.
And
right?
slingshot,
But for the most part, they're going to try and keep the kind of natural incentive is to keep the market kind of flowing through those lanes. The sort of pivot point where net gamma flips to positive gamma versus kind of the bigger chunks on the chart that show that exposure, how do you figure out kind of where the bias for the market to float is?
So that
towards the flip point versus the heavy exposure points.
So I think KG will be able to talk more on that.
Sure.
In terms of getting into convexity.
Okay.
And where we're going with that is sort of it's like are more puts being put on or taken off, and or are more calls being put on and taken off. And so it's really sometimes you get a glaring structure with this alone. That seems like, okay, it's pretty obvious we're probably going here or here, or we're probably going to end up here.
Yeah, well, there's art here, to be clear. None of this is science. This is
right.
Yeah, charting that's basic science.
At
Figuring out what to do with it is art.
Right, exactly. And at the same time, you get into the idea that if you're seeing players move the table in this way, it's going to likely drive us to this point we're watching. And then if players do this, it's going to drive us to this. So that's where, like, if you were really trying to take a stab at, like, the next level beyond this, it would probably be trying to determine are puts being bought or sold by the market participant or the market maker. And again, that's getting into some really
it's hard
deep math, and it's hard because
it's hard to delineate between those lines.
Yeah, you don't necessarily know all the time. You can try to determine it by fills at the bid, at the ask, and then maybe run a 50-50 for midpoint. But at the same time, there's no guarantee every fill at the ask was not the market maker selling or not the market maker.
I like that point, though, about trying to figure out even getting thinner, right? Just kind of take a midpoint and try and guess a little, to stretch it as deep of analysis as you can do. I really like that because, again, a lot of this stuff is to iterate a price action, visible through the price action at the top. And we see, okay, S&P goes from this line to that line. And basically what we're doing is we're going down to the field. We say, okay, the S&P traveled 10 yards, right? If we go kind of football analogy. But then this is kind of going in and saying, oh, how did they get there? Oh, they ran a play. And then this guy, it's more of kind of a play-by-play. And then to your point, you can try and take it even a step further to really zoom in on specifically how the ball is changing hands to know who's on the side of that trade. But it gets very difficult, obviously. That's a perfect place to bring in Mr. Kevin Green to join the conversation. KG, great to have you here on Gamma On, sir.
Appreciate you having me, Ali.
Of course. All right, so you just heard us walk through the gamma exposure, how to visualize all that. That pretty much gets us to what we hit on market on close in the options corner. Where do you start your interpretation and analysis once you've got that net gamma exposure chart up?
Yeah, so I think the big thing to kind of once again just highlight here a little bit is it's all relative or something that we're making estimates for, right? And so you calculated the gamma for the put side, and now you calculate the gamma for the call
exposure,
side.
yeah.
And what we're looking for is the net of that. And so you could take the call side minus the put, and that gives you either a net positive number or a net negative number. And I think that's really kind of what we focus on during the Morning Trade Live and Market on Close hits here. Where are the areas where we see a net number that is either very large on the positive end, which would be our positive gamma area, and what would be the biggest net negative number that is out there, the largest negative number that you have? That would be your negative gamma area. And I also say too, we have to just be mindful when we're making these assumptions. You're making the assumptions that institutions, retail traders are pretty much selling calls, and those dealers are buying those calls, buying those out of the money calls, making those dealers long gamma because they're long options. And then making the other assumption that retail traders or institutions are buying puts, and those dealers are going to be short those puts. And since they're short those puts, they have negative gamma exposure. So that's really, really key when we talk about those levels, the differences between the two and how we kind of map this out throughout the day. But what I basically do is the same that Shane did. I have my own processes as far as pulling the data, and then I basically chart them I put them on a chart here, and then I look at other areas of key technical areas of resistance or support and utilize just that gamma number alone and supplement that with other technicals in order to find areas of confluence. That's really the key when you're looking at this. You can't really utilize it just as a whole by itself. It's something that's something that has to be complemented with other technicals or fundamentals in the market.
That's what I really like about how we talk about it on the shows, because it becomes more clear how it overlaps and matters when you see it overlap with the other things that a lot of people might be more familiar with, where these are oftentimes aligning with levels and such. And like I said, a lot of this just kind of boils down to us understanding how the ball is moving on the ground level, like the specific kind of play-by-play of the market makers and the participants, to both your guys' points. And again, that we always try to hammer home is that you don't know the motivation behind necessarily what you see more often than not, but we can continue to try and pinpoint. So for the tool in our belt, to make sure that tool is sharp, KG, we were just talking about the read and takeaways of the net exposure gamma chart. One of the things that I'm thinking is when you see that flip point, basically, where it goes from negative to positive, but then you also see areas where there's big exposure, how do you weigh which one pulls price more? The area where there's maybe a lot of exposure, or that flip point, which to me also seems like a very important level, because that's where a lot of dealers would be pretty happy if things expired there.
Yeah, so when I kind of look at charting gamma, one thing to kind of note as you kind of talk about, it's a guardrail. I don't think it's actually a determining factor when it comes to actual price movements on a tick-by-tick basis, but it can be an accelerator. And so when you're looking at that flip line, or basically what we call net neutral, that just means that gamma is basically at zero. You don't have any skew to the downside when it comes to negative gamma. You don't have any skew to the upside when it comes to positive gamma. We usually try to talk about that being net neutral within the market, which that doesn't really provide you any type of thrust or power to the upside or downside.
That's how we zero the scale.
Price. Exactly. But when you're looking at those large bands, the positive gamma area to the upside, I look at that as an area of resistance. And then to the downside, you can look at it as an area of support up until a point. You can have excessive exposure, and I'm talking about on the index level, $40–50 billion worth of net exposure, as Shane just kind of calculated there, where if we kind of break through that level, you could actually see dealers starting to sell with the market. These levels are just really showing how dealers could potentially react if we get close to them, meaning if they have negative gamma exposure to the downside, they're short those puts. The risk to a dealer is the market continuing to go down. And there's only a couple of ways that you can hedge that portfolio. You can either utilize the options market, which they do all the time. You can also look at selling futures, or if you're looking at the individual stock level, you can look at buying stock, selling stock, utilizing stock options in order to get exposure. Sometimes when we break these levels significantly or in a very fast manner, that's when dealers are going to be on the other side, or trading with the market, if you will, right? They're selling just like everybody else is selling. And that is the key. It's not so much it's going to be an area of support. It is dealers are going to try to defend the position or defend the level as much as they possibly can. But at some point, they might not be able to. And you can look at that exposure to the upside too, these gamma squeezes that we talk about. Remember, these dealers, for the most part, are what the assumption is that they are actually long those calls. Well, if the market's going up, that's going to be in their favor. Not necessarily, because they're also trying to be net neutral. And so they have to have an underlying portfolio that they're trying to hedge at all times, trying to be net neutral as much as they possibly can, maybe have a little bit of skew to the upside or downside. And so these gamma squeezes could also create this domino effect or a melt up where dealers are also buying as well, because they can't get enough to be able to cover the position, right? And so there's ways to be able to kind of finesse it. It depends on a lot of different factors, but that's once again kind of how I look at it. I look at those guardrails. The flip line for me, that's more interesting when you get to the close of a market.
Okay.
So if we end the day, just like we had recently, where there's a lot of put positions at the 6,000 strike, a lot of call positions at the 6,000 strike, and they're just battling it out. And at the end of the day, the market pretty much closes 6,000 because it's just a draw. And those are where that flip line that we talk about really comes into play.
I like that a lot. There's a lot of draws, and then there's a lot of positive general, a more positive skew in terms of outcomes for price movement up, to the right, basically. That's just how stocks work. To your point about how to use these things and whether or not a gamma is acting as sort of a constraint or an accelerant on the market, I think also, Shane, just depends on your trader type too. Like if you're somebody that likes volatility, then you're kind of talking, a little bit about what KG is saying here, which is if you're looking for a movement down into the heavier areas or breakage, then you're going to be generally trading more looking for volatility and swings. But if you're closer to the pinpoint and you think that those walls are going to hold, then you're more a person who's going to be, selling straddles and stuff like that. You're going to be looking for more contained. You can make money either way, right? But there are different types of trades where if you start to see some of those boundaries break, then boom, the people who like to trade vol and, have exposure directionally are going to be more interested. It's not to say you can't make stuff in between while we're just bouncing between the guardrails.
No, absolutely. I mean, there's thousands of ways to trade, right? In terms of just different asset classes and different ways to look at this stuff,
right?
And then put stuff on. But some of the main.
But specifically within these charts, when you've got those big bars up there, that's kind of helping you decide your strike in a way if you're going to use this as a tool in your belt. That's kind of the idea. Is that all right? This is where I think that I'm going to bet against the market breaking through there until proven otherwise.
These can be used as strikes to trade around or with. They could be used as areas to maybe look at if you're just trading the pure underlying, so you're trading futures or stock, and you see that you've gotten to an area on the index where you think there might be some resistance above, it might give you profit-taking levels, right?
Sure.
Or stop levels to get you out. So there's a multitude of ways that it could be utilized. One way I think options traders could potentially look at it is we have this general, based on the principles and the underlying sort of accepted process of market participants selling calls, dealers buying them, and the opposite with puts, sort of market participants along the collar, dealers short the collar. With that being kept in mind, generally in a net positive gamma environment, you usually see more pinning, dips get bought, rips get sold, right? And if there is leakage, it can leak out to the upside a little bit, right?
Right. That's kind of where the skew naturally, the leakage. I guess.
And so that's where like someone trading and trying to capture that might look at like unbalanced butterflies, where it's sort of like you're shorting that initial range, but you're also saying if this breaks, I believe it's going to break out to this side. And so I'm going to skew this butterfly in a manner where if it goes up there, I will profit, right? And you're sort of hedged to the upside. Now, obviously, you're adding downside risk in a situation like that, or vice versa. If you were favoring the downside, you add that upside risk. But that's a kind of trade where you have the ability to short vol where you're at or where you think you're going to end up range-wise, and then simultaneously pick a direction where you say, okay, if I'm wrong about it not staying in this range, I'm going to at least give myself the ability to get back to break even, take a small loss or take a small gain if it breaks out to this direction.
I like that.
That's and again, the idea is net is going to hopefully tell us if net's positive, we expect vol to compress. Right? Which would mean probably more range bound and sideways to up movement, because vol going down usually is associated with sideways to upward movement.
That's usually the way things go.
Right.
Up and to the right for the most part.
Right. And then simultaneously with net, we typically see selling into dips, buying into rips, and we expect vol to sort of expand in a sense.
Right,
so
and
that
kind of inverts.
Right, and so that net negative doesn't necessarily mean down.
Sure,
it just means vol expanding.
Yeah, and then also once it's kind of normalized and the move of those dealers shifts, then things kind of normalize back in. Love it. All right, so we got some idea here on how to visualize this stuff, what to do with it, the important points to look at. And then some early talk, some brainstorming of ideas, maybe how to use it for trades. We're going to do plenty more of that here as we continue. KG, thanks for joining us. Appreciate you. Good thoughts. Shane Skinner as well. Awesome. Thanks for taking us through Excel. Thanks, KG. Thanks, Shane. Great help there getting us to visualize all this stuff and put it to some use, which is where we're going to pick it up next week with the godfather of Gamma. Cem Karsan will join us. Here's a quick little preview. You believe in the thing that people say, like the tail wagging the dog, Cem, because it's a derivative?
I hate that. Actually, I've spun that on its head because I think it's more appropriate. People always call the dog what they are
looking at,
egocentric, whatever that they're used to looking at. And everybody's been used to looking at stocks based on some two-dimensional thing. I would argue the three-dimensional as a fuller, better picture of what's happening is the dog. It's literally a three-dimensional dog. You've been looking at a two-dimensional dog your whole life, and now you're saying this three-dimensional dog is wagging the tail on the two-dimensional dog. No, the three-dimensional dog is the dog. That's the dog. The two-dimensional expresses it, right, as a function of what's actually happening.
Plenty more of that next week with Cem Karsan, and don't forget to subscribe here on YouTube, on Spotify as well, schwabnetwork.com. We've got a lot more coming for Gamma On. Thanks for tuning in.